How's it going, everyone? It's Sam. Today I want to talk to you about a new company that I had already been buying a little bit of in a dividend portfolio, but it's a new company in my tech portfolio where I put a lot of money every week. Now, I don't usually talk about the stocks I'm buying, but I've had some people reach out and say, "Hey, I really want to know what companies you're buying." So I think I'm going to do more videos like this, and it gives you an insight into what I look for in a company. We're going to be talking about a few companies, but the main one that we're talking about is the company that I just started buying in this portfolio. Now, it seems like a boring company, but it's really not. It's one that I think most of us know, or we should know, and I want to break down why I started buying it a little bit more heavily here today. Now, if you like this, let me know in the comment section so I make more videos like this. Now, if you want to know right when I buy these kinds of stocks, you can check out the link underneath the video to Patreon. Now, if you want to buy some stocks, you can definitely check out the link underneath the video to moomoo. They'll give you up to $2,000 for free, which would buy you a ton of this stock and would be great. So definitely check out that link, deposit $100. Now, what stock am I looking at? I'm actually looking at Apple. Apple is a company that up until this point, I had looked at, but it just didn't seem attractive enough compared to some other companies I was investing in. I'm not making a huge purchase, but I'm starting to dollar cost average a little bit more into Apple in my tech portfolio. And I will be buying a lot of this over time. So a lot of people don't like Apple. They think that maybe it's just not growing that quickly, or it's already one of the largest companies in the world at $2.5 trillion. They say it's a little bit expensive at a 26 PE. But when you look at it, it is actually a great company. They have, first of all, they have a great moat. So they're a very sticky business. When you think about smartphones, you think about Apple. When you think about any kind of technology, you think about Apple. It's very hard to get out of their ecosystem. I know because I've thought about it several times. You know, Apple is kind of expensive. You can't change it as much as some other technology like Androids. But it's just really easy to use, and it's something where it's really hard to move after you have an Apple iPhone, right? You want to buy a Mac, you want to buy AirPods, you want to buy a tablet. We have all of those things. We at our house have probably 5 or 10 different Apple items, and we're going to continue to buy more. They also have a growing cloud business. So they're going to continue to get more and more people to upgrade. I know I've done that several times. My wife has done that several times where we spend more and more just on storage because we want to keep our memories. We want to keep our data. And we want to continue to be able to carry that. So we pay a monthly fee. So that's great. We continue to see more and more subscription revenue coming in for Apple. You can also see their growth is pretty substantial. I mean, it looked like it was leveling out here back in 2018 through 2020, and then it exploded in 2021. If we look at the quarterly, same thing. It's obviously cyclical with the end of the year, a lot of people buying products from Apple, but as you can see, it continues to grow. It has a very high free cash flow too, which is really important because you can kind of move earnings and move earnings around to make it look however you want. I mean, you can look at Amazon for that, right? Some quarters they have unbelievable earnings. Some quarters they don't show anything. So free cash flow is really a good metric to look at. Also, when you look at the return on capital employed, this is something that I haven't really talked about on the channel. It's something I'm learning more about too. But essentially, you can look at their return on capital employed and see that they're a very highly efficient company. Return on capital employed is basically how much money you can make from the money that you're borrowing. So if someone were to invest, let's say $1 million into a company and they were able to get $10 million out of that capital that they employed, and they were able to continue to grow that, that'd be a fantastic business model, obviously, right? If I could offer you something where you invest $100 and I pay back $1,000 a year, you would obviously want to be invested in that company. But if you were to invest $100 and I said, I can give you half a dollar, you probably wouldn't be that interested. So return on capital employed is a very good metric to be looking at for certain companies. The companies that are more efficient at returning capital to shareholders are going to have a much higher return on capital employed. They also have a growing dividend, which is nice. It's not anything that I really care too much about, but it is something that in this portfolio, I'll just be able to reinvest those dividends into further buys of the companies I like. So it's just something that's a little bit nice. And then the shares outstanding is something I looked at too. A lot of people don't look at this, but this is something that's really, really important. If you're a company that dilutes shareholders, you continue to put out more and more shares, you can continue to grow revenue and grow earnings overall, but you're not actually helping out your shareholders, right? You're not actually providing more value. You're not giving them more earnings per share. So companies are able to take some of their free cash flow and buy shares because they think maybe their company's cheap. They're providing shareholder value. Apple is one of the best companies that has done this, or one of the best examples, I think. Back in 2012, they had 26.2 billion shares. Now they have 16.7. So they've reduced the overall shares by about 37% over the last 10 years. When you look at 2017 as well, they reduced from about 21 down to about 16.7. So that's 20% in 5 years. They're continuously buying their shares and being accretive to the shareholder. They're continuing to provide value to the shareholder. So all these things together, the fact that they are at a 25 price to earnings, which isn't too high for Apple, the fact that they are continuing to grow revenue, they're very sticky. They have a dividend. They have a lot of free cash flow that they're growing. They have really good return on capital employed. So another way to think about this is some companies are able to continue to grow and continue to add earnings, but they're really just diluting shareholders, getting back to the shares outstanding, right? If I issue a bunch of new shares to some company that I want to take over, I could be overpaying for that business, and I could actually be spending more than I actually get back, but my earnings continue to grow. That would be a bad return on capital employed. That would be pretty low because I'm deploying a lot of capital, or I'm employing a lot of capital, and I'm not getting a good return. This is really good. Apple's is fantastic. If you look at other companies, let's take a look at AT&T. They're a good example of a company that is really bad at returning capital. So they can grow revenue, right? They grew it here. They grew their dividend. They probably grew their net income slightly as well, but they're diluting shareholders. They went from 5.2 up to 7.3 over a few years. They were able to buy a couple companies, but they didn't get them at good valuations. Their return on capital employed is much lower. So they are diluting shareholders to be able to continue to grow overall. That's why they sell at such a cheap price to earnings ratio. That's why they haven't really moved around in price for the most part for a number of years, because they're not actually helping shareholders. They're basically just pumping out dividends. They're diluting shareholders to buy more companies to be able to increase their earnings, but they're just not really doing much. They're just stuck on a treadmill. They're stuck on a hamster wheel. However, companies like Apple are actually providing value. If you look at other companies as well, like Tesla, I did a video about Tesla yesterday. They're my top holding of all my assets. They are an interesting company because they had negative return on capital employed, right? They're burning cash pretty heavily. They're not growing earnings by much at all because they weren't even cash flow positive until recently. But they turned that around recently. A good return on capital employed, or kind of the midpoint where you see companies change their valuation very drastically, is about 8 to 10%. If they're around, if they're above that, that's typically positive, but it's a continuum. Return on capital employed for Tesla is about 15%. So they switch that around from negative to 5% to 15%. It makes sense, right? They are a company that spends a lot of cash. They built these gigafactories that are cash burning. Elon Musk has said that several times, that they are burning cash in these new facilities. So they deploy a lot of cash. At first, they barely see any return from that, right? When they're burning cash, they're not ramped up. They don't have a lot of vehicles that they can produce at first, but they slowly add on to the amount that they're able to produce in each of these facilities. And they don't have to put too much more money into the facilities after they start. They have to continue to ramp them up, but building them out in the beginning process is really expensive. So like I said, the ROCE at first, the return on capital employed, is really low. However, as time goes on, they're able to continuously scale that up, which is what I think is going to be really interesting in the next few years. As some of these early facilities become more and more efficient, their ROCE is going to go up exponentially. And they're going to show that these new facilities, these new factories, are just money-making machines. And this is at the same time that their growth is escalating very quickly, right? They're growing 50% a year, give or take. So they're able to continue to increase their revenue. They're able to continue to increase their EBITDA, their cash flow, their net income. They have a great cash position. Their net $14.2 billion. They have a growing moat. They're the best company with the highest margins in their field. And they have crazy demand right now. They also have an EV tax credit. So this is just some of the things that I think about when I think about Tesla. Now, they are diluting shareholders, but a lot of this is just due to compensation for Elon and for some of the employees. But this has been slowing down recently, right? Only 0.07 or 70 million shares that are new over the last couple of years. Or over the last year. So this is going to continue to decrease. I think they're going to buy back shares in the near future, possibly give a dividend years down the road, but they're also scaling up their gigafactories. So they're going to continue to pour more and more money into that part of their business. You can see down here that their CapEx is going up pretty consistently from 3 billion to 8 billion. So they're going to continue to buy more and more and continue to grow. And this is another business I just love. I mean, when you look at the return on capital employed and you see this growth trend, it's just going to be crazy to watch. Now, getting back to what I was saying earlier, I'm going to be buying Apple, dollar cost averaging into it. Let me know if you like this website. It's actually another creator's website that I am part of. I really like it, but let me know in the comment section if you like it. I might be able to strike a deal with them or something to give it to our community as well. Let me know. Again, check out moomoo underneath the video, and I'll see you in the next one. Bye.